Absolutely. Yeah. Thank you for having me here, Danielle. Really appreciate it. Agam, nice to meet you. So, quick background on Chorus. We started last year, pretty similar to you, I think right around the same time, probably a little bit earlier than Just Paid, I would imagine. And essentially, pretty much my co-founder, me, entire team, we have background in building risk tools and systems. That's our background. And what we saw as an opportunity around underwriting and doing risk assessment of small businesses, which a lot of people still struggle, and we saw that pain ourselves managing risk at other places. That it was PayPal, JP Morgan Chase, eBay, and all these places. We saw that like it's just not easy to do, given small businesses have like consumer-like expectations, especially the micro and small businesses. But it's not like there is a FICO for them. You could just go quickly use that to decision on them. It's just really hard. And we thought like, okay, we can start with that. That's really where we started off. Like, can we build this really good non-permissioned data that's available on every single small business in a more structured and programmatic way? People can just consume and use that for decisioning. So, for example, if you're hiring a contractor for a home today, you're probably going to Google them and figure out like, how good is this guy? Like, are people complaining about them? Are people happy with them? Any complaints, any scams and things like that? Are they licensed? How does their website look? You're probably going to do a bunch of due diligence on them to really understand who is that you're engaging with, right? There's a lot of good data on this, but it's really hard to use those data in a risk shop when you think about it, because it's just not structurally available in a structured data or a programmatically available for people to use in APIs or any of that. People still look up those data manually, like how you would do when you're hiring a plumber. That's what the underwriters are doing most times. They're Googling them and looking to understand who is this guy who just tried to sign up with us for a merchant account for payments or something like that. So we wanted to solve that problem. That's really where we started, of course. Essentially, we build this API. You can make a call with a simple check for a business, and for that business, we'll find all the information available on them online anywhere, and then give you that in a structured way within a matter of few seconds, so you can automate as much of underwriting as possible. Then we realized people love the data, but then a lot of risk people don't necessarily get engineering bandwidth to go and integrate with APIs and all that. And that's challenging anywhere for that matter, getting engineering bandwidth. And especially true, a lot more true for risk teams that don't have dedicated risk engineering teams or any of that. We saw that and we realized like, people are still using spreadsheets, Google search, and Salesforce. That's their tech stack a lot of times in the risk teams when we looked at it. So we were like, can we build a platform that can solve all of this, where they can use our data, but also can actually use that as a case management, communication with the merchants, everything in one place, essentially like operating system for risk teams in the SMB world. And we built that before. The beauty of it is like every company tries to build it on their own, but it's a massive challenge when you're building a platform like that. Bunch of data integrations, a lot of things that are custom to your company and everything, throws a lot of engineers at it to build and maintain it and all of it. We're like, can we build something that the industry can use? That's really where we are on. How do we reinvent the risk infrastructure for companies that underwrite small business? That's a journey, of course.
So I guess a question for you, fraud is running rampant, and there's a lot of sophisticated ways for people to basically take advantage of individuals. I guess just reiterating what you said, basically people are looking at Yelp reviews, they're looking at Google reviews, and I guess it's the risk teams, but also like individuals like out there, like you kind of look at like, oh, this person has 7,000 reviews, 4.5 stars. Clearly, they're probably not a fraud. So it's almost like that's how people are like taking a look at like stability, but they may not understand the financials. And I'll give you like a real use case where like there was a stable company, and I guess like, was it fraud? It kind of could have been fraud, but I'll give you like this example where there was an issue. So like in 2008, when there was the housing, boom, 2007, my uncle, true story, actually put like, I don't know, it was a lot of money down on like someone building his home. And that company had probably several, it was probably like several hundred other homes that they were building out for people. And I think my uncle maybe put 50,000 or $100,000 down, a lot of money to like have this home built. And you're trusting that builder. In 2007, 2008, it might have been out of our control. It may not have been fraud, but he lost all that money because that company went under. And in
Hmm.
some way, like, where did that money go? Right? Like, it's kind of crazy. I mean, there's other instances where people are just like taking advantage of like Google from like fraudulent invoices, right? You could send out
Yep.
an invoice, say it's like a vendor for Google, maybe it's just a food vendor. You could send out a fake invoice, fake routing number, like pizza company,
Yep.
and like defraud like the big guys, and they may not detect that because it's such a minuscule amount. But like with all of this going on, like why this space in particular? Like why not do something else? Like what was your passion here? It does seem like you have a history of like in this space, correct? Like at WePay and that sort of thing.
Yeah, yeah. I mean, this has been my passion for literally for last 15 years or so. I originally started off on the collection side, like, consumer collections and all of that, helping banks, automating collection strategy. How do you get the most out of it? All of it, because generally collections is considered a cost center. People don't want to spend a lot of money because it's their money they're trying to get back type of thing. And then I went to PayPal to run collections. Then I realized this fraud is a massive problem, and you can try to collect from people who's not a fraudster, but with fraudster, you're not going to collect anything. So that was a massive problem I saw at that time, even on the merchant level. Then I realized like there's a lot more problems to be solved on the merchant risk itself. Like, even before collections, can you proactively prevent this, whether it's a fraud or a credit risk or any of that? So that's really how I got into the risk space the last 15 years or so. I've been spending time on this. And to your point, Danielle, like fraud is a huge problem. But when I say fraud, a lot of people, immediately think about like, credit card fraud, like where, buying credit cards underground and then things like that. That's true. That's massive. And then there's a ton of different variants of fraud, right? There is like the ones you're talking about, like fake invoices sending to companies, or like, phishing, and there's a bunch of other things that happens, right? There's various things. In our world, right, in the SMB and merchant world, we see quite a few actually. Like the one you were talking about, the builder who vanished after taking the money. They may not be a fraudster, to your point, right? But there might just be a case of business going under and they couldn't pay back. But let's say your uncle paid the builder not by ACH or bank account, but with a credit card. But then, like, who's going to pay 50K to a builder in a credit card? Because most credit card won't have the limit, or people, and most builders won't take credit card for that matter. Those are all ACH payments. But then the builder isn't going to deliver until a year later and 6 months later. So there is no consumer protection for ACH. So there's hardly any recourse for your uncle to go and say, look, this builder didn't pay. Of course, you can go file a complaint with BBB or others, but then the builder is not there anymore. The business is not there anymore. So you're not going to get a money back. On the other hand, let's say if it's a $500 payment you made to a seller on eBay or who's doing a Shopify store, right? In that case, let's say you're paying with a credit card. Credit cards come with a recourse mechanism for consumers. So you could go dispute with your card issuer, and if the merchant doesn't deliver the product to you, or if it's substandard, or it's not what you order, you're going to get the money back. That's the beauty of credit cards, but it comes with a lot of fraud, though. There's a lot of consumer abuse. Merchants almost always have to pay back when a consumer disputes whether the merchant is right or wrong. That if the merchant doesn't pay, next in line is a payment processor who has to take care of that chargeback. That's where a lot of payment processors and payment companies are to underwrite the merchants. Is this someone I want to do business with? Would they be able to deliver on their goods and services that they're taking payments for? If not, I'm next in line. I have to take that as a loss. That's really the underwriting comes into play, and that's the world we live in a lot of times.
I guess I have two questions for you. Well, one is a statement, and then the other one's a question. One is, I guess, in industry, the government really does protect people in some instances from fraud, which is great, and also from like companies going under, like FDIC insurance and that sort of thing. I guess like where it falls short is like the businesses have a credit score on you, the FICO score, but like really like businesses to businesses or consumers looking at a business, there's really no way to have a FICO score in a business. It's really just trust completely. So it's like a one-way trust system where the company can look at your credit, but you can't look at theirs. That's not fair in that sense. I guess you're trying to like create a better playing field, correct? Yeah.
That's one of the reasons credit cards are very popular here in the US at least, because credit cards bring the trust factor for consumers to say you can pay today, and if you're not happy with the service or any of that, right, you could dispute it and get the money back up to 180 days. So that's the beauty of credit cards when you think about, like, and of course you get rewards and all of that, but there's just a dispute mechanism. And for merchants, they can't not take credit cards, although it's expensive for them because they have to pay 3% or whatever, because that brings a ton of business like this where consumers who would otherwise not buy something they may buy because of these things, or they don't have to pay right away, cash flow, and all the other reasons. That's a huge thing. But also that comes with the problem where if a consumer thinks like, hey, this is not what I ordered, or it's not working, or I didn't get the product, they could immediately dispute it, whether they are right or wrong. And merchant almost always doesn't win those disputes. They have to take care of it. So it's
Interesting.
sort of a self-enforced mechanism card networks brought in internally that government doesn't do. It's more regulated internally within the ecosystem.
Are you guys hyper focused on business to business protection or more on the consumer to business insights so the consumer can buy things safely, or both?
We are mostly on the business to business, right? If a company is underwriting a small business to offer them a financial product, right now we are focused on payments only. Let's say you are a software platform that have a ton of small businesses using your software. Think of a Toast or a Shopify or a Mindbody, and people have seen the examples how 70 to 80% of their revenue come from fintech products. So there's a ton of SaaS companies now. Everyone wants to offer embedded fintech products. And so they may go work with Stripe or someone to say, I want to offer payments. But the software companies are not financial companies. They're not a bank. The moment you touch any sort of fintech product or financial product, there is a risk element involved. You have to start managing risk. If your small business customer doesn't take care of their obligation, let's say you are Shopify, you are onboarding small businesses to offer Shopify payments, right? And you're taking credit card payments. And then if that business doesn't deliver on their goods, whatever they're taking payments for, Shopify has to take care of it next. So Shopify has to underwrite these small businesses. And that's not natural to Shopify when you think about it. Of course, Shopify has a ton of data on the small businesses who's coming on board and everything. But beyond that, like, is this guy going to be able to deliver on what they're taking payments for? What happens if he doesn't? This questions come up. That's really where we play in.
I guess another question, does crypto, just introducing crypto, I guess they don't have any protection. So like if I agree to buy something from you, I send you the crypto, it's kind of all on me and all that risk is on me to trust you. So they don't have any of those protections like credit cards at all. Is that correct?
That's correct. Yeah. I mean, with crypto, right, merchants would love it because the cost is really low and there's no chargeback problem, all of that. On the other hand, for consumers, to your point, there's no protection. Let's say your uncle paid the builder with crypto, right? The next second, right, there is no protection. On the other hand, at least with ACH, right, you would have a few days to get the money back or dispute it. With credit card, much longer. That's the thing with crypto.
And checks are, I guess, the same as like an ACH. You get they deposit it. There's some protections, like some period of time.
Yeah, exactly. Typically with ACH and check, you have some window where you can claim it's a fraud. You didn't authorize that payment. You can get it back. But with credit card, it goes much longer. It doesn't have to be just fraud. It could be like, hey, I didn't receive the product, or it's not what I got. It's not working as intended. You can even say 3 months later.
Got it. I never really thought about that benefit with credit cards like that. I knew that it shielded people from their bank accounts and fraud that way. But I guess credit cards, one, shield you from the banks being exposed and their account number, routing number, but it also is also protecting you in that other way now, which is a really good benefit. I mean, there's the interest rate, but you're also like paying for protections in some way. So you get pros and cons, I guess, with it.
That's right. I think from a consumer standpoint, it's the convenience, the rewards aspect, of course, the cash flow. And I think the often overlooked aspect to your point is the consumer protection that comes with it. Like, even if, yeah, sure, the 16-digit number is there, even if someone else uses, you can always go look at your statement at the end of the month and say, yeah, I didn't authorize the transaction. And they would take it off of that statement for you. You don't have to pay for it. Or you can even say, yeah, I authorized it, but I didn't get the product from this guy. Or, it's not what I ordered. You're protected.
Got it. Got it. I've been talking the whole time, Agam. I don't know if you have questions. You want to jump in and
Mm.
ask some
Yeah,
questions?
yeah. So this is really interesting, yeah, about credit card and bank accounts and how the payment system goes by. I'm just curious about the SMBs, like when we say B2B transaction between SMBs, how the risk factor, kind of jumps into the transaction, or like let's say if they do not have a particular FICO score or something where we can judge that this particular business is doing well, or are they high on debts, or if they are behind on their bills, like how and in what sense of the on the business does this affect to them, and where does this particular product comes in?
Yeah, I think when it comes to SMBs, right, there are a few risks. There are some fraud aspects to something what Daniel alluded before. When you get an application from a small business, how do you know it's from that business? A lot of times, the example I vividly remember from my PayPal days is someone tried to sign up as Callaway Golf, and then we're looking at Callaway Golf as a merchant. Sure, it's a big name, but then when you look at the data, right, the address was some apartment. I'm like, who's this person trying to do? So that sort of fraud, like what we call as business impersonation or third party fraud, is massive. We just saw one of our customers had a huge loss, and so we are starting to help them on the fraud side as well now. But that kind of thing where someone as a fraudster, you could go look at a real business, a real small business, and say, yep, I got their website. I'm going to create a copycat of their website with the .net or some other domain, and then I know their data, like who's the person involved with that business address and all of that, and then I could go sign up as them. And a lot of times companies struggle to assess, is this someone authorized to open that account on behalf of that legitimate business? If they fail on that, that's a massive thing. Then they will bring in obviously stolen credit cards and all that to process payments and get the money out. That comes into play, and then the payment processor will be with chargebacks. That's a massive fraud problem. And then there's other fraud, which is more first party fraud, as I call it, where I own the business, but I may be selling something else. I may be selling something that's illegal or risky or whatever, but then I go to my payment company and tell, yep, I'm selling clothes or electronics and things like that. So they think you're selling electronics, but you're actually selling something they don't allow. And, the payment patterns don't match up and all of that. And then eventually the payment company might end up getting fined by card networks or other issues. These are massive fines. So there's a lot of issues with that. And then to your point, like if the merchant is legit, how do you know this is the person that's not going to fail from a business standpoint? Like, so I don't end up having chargebacks as a payment processor or a software company. Not just looking at their prior bills, like have they been keeping up, whether it's from Dun and Bradstreet and others, because a lot of times they're very reactive, and also they don't have great coverage for small businesses. That's the thing. If you're a large business, generally the Dun and Bradstreet of the world will have a lot of data. But that's where if you go look up online, how is their presence? How are they getting the customers? What are their customers talking about? How professional they appear on the website? Do they have the right elements? So a customer coming in will be happy to give their credit card and transact with them. Are they in good standing otherwise with other places? Those are the things you can easily check, but it's very manual today. That's a problem we're trying to solve for. And then on the fraud side, we're starting to help our customers as well. How do you identify merchant fraud from applications based on ton of data out there to tell them like this is not the right website for the business, or the email address does not belong to this website? There's a bunch of information we can do. So we are starting to help them as well on that.
You brought up a really good point about DNB. Why don't they cover small businesses? Are they just, that's not the way they operate? And even like, what do they even do? Like, I believe it's called Dun and Bradstreet. Is that like a credit score, or is it just a large corporation that kind of gives some insights into companies? Like, I never use it. I don't think business owners use it quite often to do much research, unless I'm wrong. You would know way more.
Yeah, it's one of those, for lack of a better word, right? It's sort of elitist score. It's not like a FICO, everyone automatically has something, right? Because I have to go open a file with them, I have to pay for it. And, unless I share financials and others, right, they probably won't have any information on you. So think of the restaurant at the corner. They're not going to go do all of that. They're not going to go spend money and all that. A lot of times people end up opening like we did. For example, if you're working with the government or something like that, right? They ask for your, do you have a Dun and Bradstreet DUNS number or something? Then you have to go do it. And even then, unless you provide your financials or other instruments, other information about them, they're not going to have much of credit data on you. Then there are some credit bureaus like LexisNexis and others have some data they collect, but in general, they are very reactive. The data points, they're not super predictive on how you're going to act as a business. That's been my experience.
I guess you're trying to modernize like DNB. You're trying to modernize it in a newer way. Like they're clearly missing something, right? And it seems like you're taking advantage of that hole. Sorry, you're going to say something.
Yeah, no, exactly. I think what you said, like that's really where we are going. Our vision is really, can we get to a point where businesses anywhere in the world, whether you're a real small mom and pop store, or it could be a restaurant, or it could be a large business, can you get access to credit easily and quickly without having to give so much of information and financials and all of that, where companies can easily underwrite you based on all the information available on you? That's really hard today, and not just between different countries, but even within like, highly developed country like US, it's really hard today. The data is very fragmented, unstructured. It's just hard to do.
So just going back a little bit, let's change topics a little bit. Like starting this company that you started, I think it's rare for people to get into Y Combinator and to create this type of company and get funding. Like I'm assuming you started, like you went to school, and where did you go to school? Is it India or somewhere else? Or
Yeah, I did my bachelor's in India and went to grad school in upstate New York.
and then like how did your journey lead to Silicon Valley? Like, like it's such a, many people just kind of stay where they grow up, right? So like what made you come to the US, and then like you kind of had a crazy journey like traveling the world, right? Like what made you go this path? Like
Yeah, great question. It's a long and winding journey, I would say. So I finished my bachelor's. I came to the US when I was 20, did my master's, and went back to India actually after my master's. Worked there for a couple of years. Then I came back here again, worked at a cool company, cool startup in Austin. It's a small boutique startup. It's not there anymore. It got bought by another company. They were building software and models to predict what's the best time to call people for collections and marketing and other purposes. So essentially, these were the days before you had data science and any of that, right? In mid 2000s, all that. And we were building models to come up with like, based on massive amounts of data and all of that, like from banks and others to understand, okay, should we be calling someone at 11 a.m. or 12 p.m.? What is that, right? Then you would optimize for, if you go to a collection shop, they may have 300 collectors trying to call people and all of that. And then they know not everyone's going to pick up the phone and actually answer when you want to collect and all that. And then there are regulations in every state. You can't call people, federally, you can't call people before 8 a.m. local time or after 9 p.m. local time. And then there are state level restrictions on how many times you can call anyone, how many times you can call them on the cell phone, all that. So we were basically building software that takes all these constraints and come up with a really good schedule to optimize for how do you get the most money collected, that sort of thing. That was really cool. So I loved that. I did that for 4 or 5 years. Then I went into PayPal to do collections. After a couple of years, I realized like I really love more of the risk side of things, more upfront. So I started going into merchant risk, seller risk, and all of that. I did that for their payments product, working capital product, and all of that. Then worked at a few other companies, PaySafe, VPay, and then VPay was a YC company, as you know, and worked there. I ran risk and compliance there. We got acquired by JP Morgan Chase. It was a massive moment for the company. And then I learned a lot, obviously being at the bank as well for a couple of years after that. I ran the integration with Chase on the risk side, compliance side, as a face of VPay to regulators like OCC for a while. So great learning moments. And then went to Google for a year, ran risk. But I realized my calling is really like go build something like this. So partnered with my colleague from VPay who ran risk engineering and data science. So we both founded Chorus last year, quitting Google and starting this last year. Went through YC. It's been amazing since then.
that's awesome. So you went through YC, which batch?
Summer 22.
Summer 22. What was like one of the best parts about it? Like what made you like that program? Why even go through that program? Like why not just start the company? I mean, backtracking, you were at WePay. That was a Y Combinator company. then you went to Google, which is a massive company. Like something pulled you back in, and then you wanted to
Mhm.
apply to YC for some reason.
Yeah, I mean, that's a great question. So, to be honest with you, I was somewhat skeptical of going through YC, personally, me, at some point. Then we started talking to people, and then Rich Aberman, who's a co founder of vpay and who's also a visiting group partner at YC at the time, he was helping us quite a bit on like how to think about like founding a startup and all that. And then he actually convinced us like, going through YC is a great idea for a variety of reasons. Because you would argue like, we should have enough network and enough credibility to go build a company ourselves. And which probably is true. It could have worked out as well. But YC brings a few advantages that you won't get otherwise, in my opinion, which is the network YC brings and the lessons and then the things they tell you like what to do and what not to do, more importantly, especially as Michael Siebel always says, like, we can't tell you like, all the things that's going to make you successful, but we can always tell you all the things that can make you fail. And how do you avoid that? How do you sidestep that? That was massive, in my opinion. I think it's really hard to get that outside YC. That was massive. And then, of course, YC, getting into YC, and then going through that pressure cooker for the 3 or 4 months, right? Literally, you build a product that they help you accelerate and go fast, and then prepare you for fundraising and all the other things. It's just, I don't think you would. Sure, you can do it outside, but I just think it's really hard to do for first time founders, especially to do that. I would love to ask you, like, as a second time founder, what made you go through YC again? Just curious.
Yeah, I mean, for me, I think I really like the boot camp aspect of it, where it kind of pushes you beyond your normal limits. Like, they're very, very good at like pushing you to work 24/7. And I really like that about the YC team, because without that inertia and momentum, it's very hard to start something. And there's a lot of pressure points like demo day and alumni day and the weekly meetups and the check-ins and asking the other founders like what and how they're progressing. It creates a huge amount of positive pressure that I personally love. And I wanted to do it again because I knew that that pressure was needed. A lot of founders have a lot of inertia, a natural inertia to build something on their own. I know that some places I'm weak and some places I'm strong, and pulling in third party smart people, like honestly Richard was one of our advisors as well in this company. He pushed us really, really hard through the up until demo day in terms of getting as much product and usage and traction like out there. And for me, I always use this analogy. It's like going to do you want to like work out at home, do push-ups at home, do sit-ups at home, or do you want to go to the gym and see like what some of like the people that are taking their health serious are doing? And when you see all of that, you're like, okay, these people are really taking care of themselves. I need to be doing X, Y, and Z also. I think Y Combinator has a lot of that really good startup hygiene. It's like get your company set up properly, get
Mm-hmm.
really good investors on board, and push yourself like nonstop. And when you see a lot of that energy, even the second time around, it's like a no-brainer for me, like doing YC. So, I mean, let me throw it back at you. Would you do Y Combinator again? Like, if this company becomes huge and you sell it, like, is that something you would do again? Question for you.
I think so. I mean, it's hard for me to predict what
Yeah.
what situation I would be in, but I would, if I had to say today, I would say so, yes, because I think, to your point, the hygiene around like starting a company upfront, like what are the things you have to do and all that, they make it so easy. Sure, you can argue someone else could also make it easy outside, but that's not the only thing, in my opinion. That's one thing, and that in itself could be massive. On top of it, like some of the resources YC has, like whether it's book phase or the network, and how you can reach out to any other YC founder quickly and get their thoughts, and then like the weekly talks and all of that, right? I think everything compounds, in my opinion, together. It makes it a no-brainer overall. And then to your point, the whole boot camp thing is just like, get you out of that inertia and then like get going quickly. It helps a lot.
I mean, we wouldn't have met if it wasn't for like YC connecting us and saying you guys should have
Yes,
dinner together, right? So that was all them
true.
like doing that. Yeah, so sorry, Agam. Why don't you hop in and ask some questions that you had? I'm sure you're like processing all of this.
Yeah, so that's great. Both of you went to IC. You guys network there a lot. Like, just want to understand from you, Vinod, like, what was your journey so far since you have started this particular venture, and where are you heading towards?
I mean, it is most startup founders would say, right? Some days are great, some days are awful, right? That's just the roller coaster you have to go through. And it's also, I think, one thing I was very prepared is, you have to be able to do anything and everything to make your company successful. Like, I always joke, like, my role as a non-technical co-founder involves buying snacks for the team to responding to Slack to our customers all the way, everything, right? It's a catch-all job in that sense. But ultimately, whatever you do, it's for the company. And but you also need to be able to prioritize or ruthlessly. That's one thing. What really is going to move the needle for the company from growing the company standpoint, revenue standpoint, that's really important. But you don't want to sacrifice like setting the right tone and culture for the company as well. That's also equally important. So those are things like, just figuring out what matters at this stage of the company and then focusing ruthlessly on that and not spending time on things that may make you feel really good but not needed for the company at this point. Those are things that's been the biggest learning, and trying to get better at it every day, but that's been the big thing.
Yeah, that's really awesome. Yeah, and that's one part, you learn when you start your own venture. Maybe in future, even I look forward to it, and that's gonna be like a life-changing thing. But at the same time, how do you see that, you guys are keep moving forward? Like, at times when you get too much occupied into the operations and taking care of things, how do you see that, you have stepped up or you're moving in a positive direction?
I think one thing I learned from YC and our group partners is like, set a goal, right? I think that's a good thing about when you go through the YC program, there'll be goals for every 2 weeks. You are signing up for goals yourself, and then you're actually trying to meet that goal every 2 weeks. Even if it's a small goal, it's important to have a goal. So that's one thing, like, we are trying to have that hygiene as well, even outside the YC program. Can we have a goal, if not every 2 weeks, at least a monthly goal, right? Because we are on the B2B side of things, things don't move as fast on the B2B when you're trying to sign up enterprises or all that. So, but it's important to have a goal though, so that we try to have a goal, monthly goal, and measure ourselves. Are we doing something that's going to help us grow and meet that goal? Right. That's the question. If you keep asking every time, that'll help us understand: is this worth doing it now, or is this not worth doing right now? So that's been very helpful for us so far, I would say.
Got it, got it. That's really awesome. Yeah. So keeping up the milestones and trying to achieve it at the time, like when you have decided, that's really the way you judge that, you're moving forward. In terms of product development, like, understanding the market, it has been evolving and changing all the years. How do you see that, in future, what it's gonna be like? I see that SMBs are more driving more revenue than even like the big giants in even, let's say, retail industry. Walmart is doing great, but at the same time, if you collectively look at the numbers for SMBs, even they are doing great, and people are now trusting smaller brands as well to do their or get their products. How do you see the next 5 years in the industry, and how have you envisioned your product to build over the time?
I think my point of view on this has evolved quite a bit over the last few years. I saw this when I was at JP Morgan Chase as well. And then, if you think of a brand like JP Morgan Chase, they're a huge bank, number one bank in the country and all that. And they pride themselves on their brand, where people come to their branches or to their app and actually do business there, right? But then what I've seen is the last few years, and I think the bigger banks like Chase are also recognizing now, is like a lot of these businesses, especially small businesses, they are moving to more software side of things to run their business, whether it's Toast if you're running a restaurant, or a Square for running a restaurant or a shop, or it could be a Shopify if you're having your own e-commerce store, or it could be a House Call Pro or Jobber if you're a contractor or a plumber. So there is a software for every vertical today to run your business, to run it efficiently and all of that. And people love to get the financial products right there within the software at the right context as well. So when you're sending an invoice to someone, for example, you want to offer them the payment options. Sure, you want to offer then payment processing along with that. Can you also offer them a loan or a working capital based on the invoice, right? So there's like a ton of things you can do in terms of embedding financial products along within the software product. I think that's really where this whole embedded finance and vertical SaaS, I think that world is growing tremendously because it makes sense because small businesses are strapped for time and they're not going to have time to go to the bank and deposit their checks or do the business or whatever. It's easy for them to just take care of all of that within that one software used to run the business. And I think banks are also recognizing it and they are building products for the vertical SaaS embedded finance economy. I think that's a massive shift in the way how financial services were offered and sold. There's no more going to the bank. Banks are coming to SMBs. Are they doing the business? I mean, in this software, that's a massive shift in my opinion. I think consumers are slightly different. Consumers still want to go to banks. A lot of fintech companies are doing a great job for sure. I think it's a different paradigm, I believe, the consumer side versus small businesses are very different, I believe now.
So just for the audience, embedded banking, you kind of glazed over that so fast. Like, what is that? Like, is that the bank is inside of the product like Shopify, or is that something else?
Yeah. So the way I look at it is, right, you as a small business are using a software to run your business, right? It could be any software. There's a ton of software these days, and a lot of them are verticalized so that they really understand your operations. You can run that, right? If you're a restaurant, it makes a ton of sense to use someone like Toast or Square, right? That sort of thing. And the software actually has the right context on where your business is, what do you need, and all that. So, for example, you have employees set up in your Toast system or other things, right? And you know how many orders are there, how much money you collected using embedded payments Toast offers. Now you want to do payroll or the tipping, how do you share the tips with your employees, right? It makes sense for Toast to offer embedded payroll as well, right there. On the other hand, let's say you're using Shopify as an e-commerce seller. If you run your online store and then you're using Shopify, Shopify allows you to accept payments in your online store easily. Sure, that makes sense. That's embedded payments. But now I want to access that money quickly or make a payment to my suppliers as an online store. How do I move the money? I don't want to take the money from Shopify, have that go to my Chase bank, and from there I want to wire someone. It's multiple hops. Can Shopify just facilitate that? That means Shopify has to offer a wallet or a bank product with money movement capabilities and all of that. That's where the embedded banking come into play, where you use Shopify to build your store, also use Shopify payments to accept payments, and then you can use Shopify's banking product called Balance, I believe, to move money to pay your suppliers or other things. Oh, by the way, can I also get a loan? Because Shopify has all my history now, how much I'm selling, how much money I'm making, all that. Can I get a working capital loan from Shopify? Yeah, that's Shopify Capital. So all these financial products get interwoven, and then based on the context of where your business is within the software, they can offer various financial products. And it could be embedded insurance in another software. Like Dutchy is a great example where they work with cannabis businesses. They need insurance. They're offering embedded insurance. Or it could be charge card, right? A ton of companies that offer embedded charge cards, knowing your business within the software and all that. So there's a lot of these financial products that get embedded and interwoven. That's a massive paradigm shift, in my opinion, on how small businesses run and how they access these various banking or financial products. No more going to bank and getting a payment processing or merchant account or bank account and any of that. It's just very different.
Do you envision your company being an embedded? I think it's primarily an embedded product, correct? So
That's right. So we are super bullish on that. I mean, this is the trend I saw with whether it was at BPay or JP Morgan Chase. We saw how much platforms were gaining, how much platforms can grow, and this whole flywheel effect they can have as well by offering more and more financial products. There is not just more revenue, it's not just better, it's much better use of time for small businesses, but also better stickiness for platforms where small businesses are going to stay with you for longer because you offer way more products than just software. It's only going to get better and better, I believe. And the way we think of Core is helping here is we help software platforms to manage risk when they offer embedded payments today. But ultimately, as we get more and more data, we can also help them manage risk when they offer other embedded financial products, whether it's a banking or a charge card or a payroll. How do you know if you should be offering this embedded financial product to that small business? How do you manage the risk across the board on all these products in one place? That's really we want to play. So for example, today we have an integration with Stripe. If you are a software platform offering embedded payments through Stripe, you can start using us with one key. Give us a key, and then within a matter of minutes, you can get going with us. And then you can manage risk of your merchants on Stripe using our software. So let's say eventually we integrate with other providers as well, not just Stripe. It could be a Gusto embedded that's offering payroll, or it could be some of the BaaS providers offering banking. And then you can manage the risk of a merchant across all these various providers for your different products. That's really where we want to go.
Got it. So you are quick connect into Stripe, a quick connect in the future, possibly Gusto, a quick connect into maybe
Yep.
Shopify in the future, and then people just feel more protected. Will you just spit out a credit score? And will it be that simple? Or I guess there's way more complexity to that than just a credit score, or is it that simple?
I think credit score is one simplification of how we view a business, right? But it's also like, leverage and all of that, right? For example, are you seeing, some stress points for a business in one product? Like, doesn't mean like, they're going to struggle with another product and all that. Doesn't mean exposure for you across the board. How do you manage it, right? On the other hand, if they're doing really well on one product, would you give them more credit or better leverage for them in other places? So for example, if you're seeing them, they have this massive promotion going on, and then they just had a huge explosive growth on the payment side, right? Would you give them some sort of like working capital in a proactive way so they can pay their suppliers and things like that without them waiting for a few days for the payments to clear or other things, right? For example, if they're going to do a promotional sale, would you give them the working capital even before they start taking payments? There's like a lot of things they can do as an interplay between all these products, but how do you manage the risk exposure across all of these? That's important.
Right. Right. Shifting gears. I know we're running out of time, but maybe shifting gears. I want to ask maybe one or two more questions, and then maybe Agam, you could ask like ending questions. But I think the world is really changing where fraud will. I really believe AI is going to do good in the world, and I think for the most part, it's going to be really effective with helping. I think the dark side of where AI can maybe hurt people in the future is generating AI voices to do, fraudulent activity, generating AI visuals to do fraudulent activity. Where do you think AI will do good, and where do you think it'll do bad as we progress in the AI space?
Yeah, I mean, totally right. It's a double-edged sword, right? To some extent, they're definitely fraudsters getting very savvy on using synthetic voices and other things, right? Even like if you're verifying a customer, right, for KYC and other purposes, right? AI is already in play, right? In terms of where fraudsters are using that to do like fake selfie stuff and all that, right? That's happening quite a bit. On the other hand, I think AI will also help us better understand who the businesses are, who are the legitimate businesses, who are not, and all of that. And also like in general make the whole risk world much more efficient, because a lot of it is still very manual. Ironically, even in 2023, I feel, but that's where I think AI is definitely giving us better context on how should we assess a business and all that. So I think it's going to be a cat and mouse game, as has been the case in general in the risk world for a long time, where fraudsters are going to look at like how can they use this AI stuff, whether it's GPT or other things, to defraud like more and more folks, right? On the other hand, like companies are also going to look at like how can I use this to streamline my operations or better understand who are the good ones, bad ones, or who are going to be in trouble later, so I can take proactive actions, or how can I read the financials automatically instead of someone manually reading the financials and coming up with like how good a business is. So there's like a lot of use cases, and we're starting to help our customers a little bit on that already. But it's definitely going to be an interesting thing with the AI coming on board. A lot of these.
Awesome. Agam, I'll let you finish up since we're running out of time.
Sure, yeah. Last question for you, Vinod. Just looking at your journey back so far, if you have some lessons or something which you would have known before and you would like to share with everyone, some key points which you learned over the time, or something you realize later on when you are already in the market, some good lessons which you can share with all of us.
I mean, I don't think I've come that far to start sharing lessons as much. But if there's one thing I would say is just something top of my mind all the time, which is like, generally trying to be curious on trying to understand how things work and why things work the way they do and why not some other way. That's really helped me, and not just trying to go by status quo in terms of just accepting as things are. That's generally the one I feel like that's important, especially as you grow in age. It's easy to get cynical. It's easy to just assume things are the way they are. But, as I read somewhere, right, the things around you aren't built by people, much smarter than you. I think there's always scope for making things better. So that's something to keep in mind. So that's something I always think, like when I marvel at something like, wow, this is amazing, which is great. Like someone is smart enough to do that. But there are also a lot of other things that can be much better, especially in the industry we are in, the financial services, right? Things can always be better. So I remember that. Yeah.
That's awesome. Yeah, thank you. Thank you so much for sharing this, and thank you so much for spending this time. It has been great speaking with you.
Yeah, no, thank you so much, Vinodh. This was awesome. I know it's the day before Thanksgiving, so I'll let you go and enjoy the rest of your time with your family and whatnot, and whoever you're around. But yeah, anyway, this was amazing. Thank you again, Vinodh. Happy Thanksgiving, also.
Yeah. Thank you guys. Thank you, Danielle, for having me. I know we've been trying to do this for a while, so I'm glad like we could get on and talk about things for an hour. So thank you for having me. Really appreciate it. And of course, happy Thanksgiving. For some reason, it doesn't feel like Thanksgiving week this time of the year. Lots going on still for a Thanksgiving Eve. So interesting.
Awesome. All right. Well, thank you so much, Vinodh.
All right. Nice talking to you guys.
Thank you.
Later. Bye.
Bye.